What if I told you that the massive Vanguard and BlackRock buying you saw in the latest 13F filings is a calculated trap? Retail investors are logging into their accounts right now, seeing huge institutional ownership spikes in nuclear stocks and throwing their life savings at the screen. They think they are riding the coattails of Wall Street geniuses, but they are walking straight into a meat grinder. The financial media is screaming that the smart money is backing nuclear energy to the moon. They show you the clean charts and the rising ownership percentages to make you feel safe buying the top. But the truth hidden inside the dark pools tells a completely different story. Wall Street is playing a brutal game of mechanical extraction. High institutional ownership does not mean what you think it means. While you are cheering for BlackRock buying millions of shares of your favorite nuclear stock, the actual smart money is quietly slipping out the back door. You are misreading the entire tape, and it is about to cost you everything if you do not wake up right now. If you own a single clean energy stock or a speculative AI utility proxy, your entire portfolio is sitting on a ticking time bomb. Hit subscribe and drop a like immediately, because we're pulling back the curtain on the raw dark pool data that the mainstream financial gurus are too terrified to show you. We track the actual whales to ensure you never become retail exit liquidity again. This channel is your defense mechanism against institutional distribution. Protect your capital by locking in your subscription right now, because the post-May 15 structural rotation is accelerating and the market will not wait for you to catch up. Let us expose the mechanical illusion. When you see BlackRock or Vanguard accumulating millions of shares of nuclear stocks, they're not making a high-conviction fundamental bet. They are not doing deep-dive research into reactor technology. They're simply running passive index replication funds. They are legally forced to buy these stocks. When a sector gains momentum and its market capitalization inflates, passive ETFs must automatically purchase matching blocks of shares to mirror the index. It is an unthinking automated algorithm. Retail sees this forced buying on screeners and mistakes it for smart money accumulation. It is the ultimate cognitive blind spot in modern investing. Passive funds do not care about valuation multipliers or macro headwinds. They will blindly buy the absolute cyclical top of an overextended sector simply because their mandate commands it. Retail tracks these lagging institutional metrics and buys into the peak of a crowded trade, thinking they have major Wall Street backing. Here is the second-order trap. Active hedge funds and corporate insiders understand this passive index tracking mechanic perfectly. They know that billions of dollars of forced ETF inflows are legally bound to hit these specific nuclear tickers on rebalancing days. This creates a massive ocean of predictable retail and passive liquidity. The active smart money uses this exact forced passive liquidity as their perfect exit door. They can dump millions of shares of overvalued nuclear plays without crashing the public market price, because the passive index funds are legally obligated to absorb every single sell order. It is a massive invisible wealth transfer. While the passive allocation percentages climb on your retail stock screener, the active high-conviction capital is secretly fleeing the sector. The whales are leaving behind a hollow shell propped up entirely by unthinking index funds and clueless retail bag holders. You are buying the exact shares that the smart money is discarding. Why must you understand this today? Because the mid-2026 first quarter 13F filings just dropped and the massive post-May 15 capital reallocations are executing right now. The divergence between active distribution and passive accumulation has reached a historical extreme inside the nuclear sector. The structural rotation is hitting its final peak. Dark pool volume spikes indicate that active institutional blocks are moving out of speculative infrastructure names at an unprecedented pace. The liquidity mirage is starting to dry up as the summer peak grid demands approach. If you do not position your portfolio ahead of this mechanical shift, you will be crushed. The exit door is shutting fast for crowded energy trades. The window to front-run the institutional rebalancing is closing this week. We have run the data through our filters and quantified exactly which nuclear tickers are hollow passive traps and which single name is the true active smart money conviction play. Let us execute the countdown, starting with the most dangerous speculative traps on the board. Number 5 is Nano Nuclear Energy ticker NNE, along with Oklo ticker OKLO and NuScale Power ticker SMR. These micro-cap and small-cap vehicles are the absolute epicenters of retail euphoria and passive distortion. These companies possess tiny tradable floats and zero near-term cash flow. When speculative retail sentiment spikes, it forces thematic clean energy ETFs to aggressively buy shares to match the sudden capitalization weights. This creates an artificial massive momentum squeeze that has absolutely nothing to do with fundamental corporate earnings or real reactor contracts. The dark pool tape reveals that while passive inflows prop up the stock prices, active corporate insiders and hedge funds are using this parabolic retail surge to aggressively liquidate their positions. NNE, Oklo, and SMR are highly volatile liquidity traps. Do not mistake forced index tracking for active long-term validation. Moving down the risk curve to number 4 is Vistra Corp, ticker VSD. This has been the ultimate crowded momentum proxy for the AI data center build-out. Mainstream financial media loves to highlight VSD because of its massive institutional ownership percentage. But that density is exactly why the near-term upside is capped. Vistra has been hyperinflated by massive forced passive inflows after being added to major growth indexes. Active smart money accumulated this name sub $30 long before retail heard about it. Now, at these elevated levels, the active whales are trimming exposure while passive ETFs are forced to hold the bag at the top. Vistra remains a solid fundamental business, but its current valuation multiplier leaves absolutely zero room for execution errors. Any delay in grid modernization or data center power connection will trigger a brutal institutional de-risking event. Do not chase VSD at the literal peak of a crowded passive indexing cycle. Number 3 on our countdown is Constellation Energy, ticker CEG. This is the undisputed giant and the reliable S&P institutional anchor for the entire nuclear utility sector. Because of its massive market capitalization, CEG is the default first-tier purchase for every single passive index fund tracking clean energy. When retail investors buy broad market ETFs, a massive chunk of that capital is legally funneled directly into Constellation Energy, regardless of its valuation. This massive mechanical tailwind makes CEG highly resilient during minor market pullbacks. It acts as a safe asset base, but that safety comes with a major cost. Because CEG is completely saturated by passive institutional money, its valuation has been driven to historical extremes. The upside from these levels is heavily restricted. Furthermore, as a massive regulated utility, its profit margins are constantly vulnerable to political and regulatory interventions. CEG is safe, but the explosive alpha is gone. Now we transition to the dark horse. The single asset that the active smart money is quietly accumulating while retail is distracted by speculative memes. The number 1 high conviction setup in the entire nuclear space is BWXT Technologies, ticker BWXT. This is where the actual active whales are hiding their capital. Unlike the speculative reactor plays, BWXT owns a complete structural monopoly on the manufacturing of critical nuclear components and fuel enrichment infrastructure. They're the actual foundation layer. Without their proprietary engineering, none of the high-flying utility companies can actually scale their operations or power a single AI data center. Look at the structural tape. BWXT has been completely overlooked by the speculative retail crowd because it does not have a hyped-up social media presence. This means it is shielded from the massive artificial price distortions caused by crowded passive ETF rebalancing. Its current valuation floor is backed by solid multi-billion-dollar backlogs. While retail is busy chasing hollow floats, in Oklo active hedge funds are quietly accumulating massive blocks of BWXT in the dark pools. They are buying actual moat-protected infrastructure before the passive ETFs are forced to discover it. This is how you execute a true asymmetric second-order trade. BWXT represents the ultimate high-conviction choice because it anchors the entire nuclear supply chain. When the speculative retail hype dies down and the hollow proxies face liquidation, the capital will inevitably rotate into the only company that controls the physical manufacturing bottleneck. That is your ultimate alpha payoff. Let's establish the cold reality check. Write this phrase down and stamp it into your trading plan. A low stock price does not mean a cheap company, and a rising institutional percentage does not mean smart money is buying. Retail investors constantly destroy their capital because they fail to understand market mechanics. You must separate unthinking passive index tracking from active high-conviction accumulation. If you blindly buy utility stocks simply because Vanguard owns 10% of it, you're setting yourself up for financial trauma. Define your precise valuation boundaries and look for companies that own physical monopolies. A true buyer-side operator never chases a stock at the peak of an index rebalancing cycle. When the market provides a red day, you do not panic. You treat it as a mandatory shopping list to accumulate real high-conviction assets like BWXT, while the crowd is getting liquidated in crowded traps. The game is laid bare before you. Wall Street is using the mainstream media to scream about institutional nuclear accumulation while they quietly hand over their overvalued shares to passive ETFs and retail bagholders. The smart money has already made its move, and the rotation is entering its final stage. Are you going to keep holding the bag for passive ETFs, or are you moving your hard-earned cash to where the active whales are hiding? Do you have the courage to cut your speculative traps and back the actual infrastructure monopolies before the market reprices them? The choice is entirely yours. Drop your specific nuclear ticker in the comment section right now. Tell me if you are holding a hollow passive proxy or if you're positioned alongside the active whales in the dark pools. The comments are open. Let us settle the tape down below.